Okay, yeah, good morning. Before I start, just a quick thank you to Digital Penang and all the organizers for inviting me. I really enjoy coming up to Penang. The last time, I think a few months back, there was a pitch session that was held in Spice, City of Spice, that was organized with Digital Penang as well, and I attended that, and we actually ended up speaking to quite a number of the startups from there to do due diligence. So we're really looking forward to actually do more work in Penang. Even though I'm from KL, we want to make sure that we diversify our presence as well. So thank you so much for inviting us. Before I start and before I give some context to this talk, can I just ask a quick show of hands? How many of you have raised a first round of funds? Okay, how many of you are hoping to raise your first round of funds? Okay, good. And then the rest, you second, third, or not at all? Okay, okay. So thank you to Amri for this suggestion of the title, Understanding Early Stage Investor Appetite. I think it's a very good way to describe. We actually have an appetite, but the thing about, so I'm from Bawatana, and we like to, if you speak BM, you know Bawatana actually means underground, so that's why our tagline is unearthing consequential startups. And so we talk about appetite, and I think this is really a good way of explaining the different type of investors you'll be speaking to. There are those that are probably a bit greedy. There are those that probably like to throw around money. And then there are probably some of them that are a bit stingy, right? So if you've spoken to investors, you probably come across all these different type of potential investors. So what I want to do today, and I hope the biggest contribution I can do to this session and for you, is to try and get you to understand what we see when you come and talk to us. I think that's really probably the most helpful, right? And why I say that is because we always talk about building an ecosystem, but this is the reality. We sit on very different ends of the table, and often it's a very long table, right? It can be very impersonal at times. And I hope one of the things that we can contribute towards is to sort of bring the different sides a little bit closer. And the way to do that is for us to maybe be a little bit more open about what we see. And one of the things I realized, first of all, is that what you think you are telling us from your pitch deck is actually very different from what we see when we look at your pitch deck. But it shouldn't be a secret. It shouldn't be something that we try to protect. I think it's better for everyone if we all understand, actually, when we look at your pitch deck, what are we looking at? So that is my goal for today, okay? So the first thing is that there's this, if you study economics, there's this idea of information asymmetry. Information asymmetry simply means that one party has advantage over the other. One party knows a little bit more for various reasons. Maybe they have an advantage position, so therefore they can sort of exploit that situation, right? And I think that sort of, if you look at this kind of investor, they thrive on this asymmetry because they actually have better information than the founders. So I hope whatever startups we work with, I hope they don't pigeon us into being this type of investor, right? So what do you want as a startup? If I were to make a guess, you would say obviously you want funds, maybe you want access, maybe you want networking, maybe you need a little bit of mentoring. Those are the things that you want, right? Then on the other side of the equation is, what do the investors want? So this is where the first thing comes about. And I'm going to try and break down the half-an-hour talk that I have into 3 key things that you should hopefully leave today understanding. So the first thing is, number 1, not all investors are the same, right? And because this is really targeted towards early stage investors, I'm only going to focus on likely the two type of investors that you're going to speak to. There are others as well. If you're later stages, they're probably institutional investors, there's probably private equity. By your stage, sorry, at your stage, most likely you won't be dealing with those kind of investors. You'll only be dealing with angels and smaller funds or smaller VCs, right? Now, the thing is, the first thing you have to understand is that actually they have very different stakeholders. And you understanding the investors and their stakeholders will really help you understand how they look at their investment decisions. So very quickly, one question. So this is, if I just quickly go back, sorry. Oops. Okay, so the two investors here, as I mentioned, is angel investors versus VCs or small funds. It's kind of the same thing. The reason I don't particularly use the word VC is because in Malaysia, if you say you're a VC, Securities Commission has a very particular definition of what a VC is. So there are a lot of people who they operate as a VC, but they're not really registered with Securities Commission. So I'll just use the general term funds, okay? So, an angel investor, who do you think their stakeholders are? Sorry? Themselves. So, if they invest money, at the most, they have to answer to their husbands or wives, right? That's basically it, because it's their own private money. So, the way they make decisions is that it's their personal funds, and so therefore, they are taking on the risk themselves. But if you're speaking to a fund, you have to understand that funds are operating on the basis of they're investing other people's money. So therefore, they have a very different responsibility. And that actually clouds how, so like for me, I'm a fund, that clouds how I decide in terms of investments. Now, what are the differences? Number one, as a fund, first of all, I approach it as a portfolio. I will have a fixed amount. Let's just say my fund size is 10 million. That 10 million will dictate how many startups I can invest in. Because I have a fund, I have economics. I won't get into details because it's a very fascinating area, but it's probably beyond the scope of this talk. But I have a limitation in terms of the number of checks I can write and how many startups I can invest in. So therefore, I need to balance my portfolio. If, for example, I already have like 2 or 3 fintechs, I might not invest in another fintech, even though it's a good company, because I'm overexposed in that space already. Secondly, I have to worry about how much risk am I willing to take, because I'm actually responsible for other people's money, right? Whereas an angel, the risk is personal. But what an angel doesn't have is the upside of a portfolio. Because an angel invests almost a la carte. So they invest like, okay, I like this company, this year I have some extra money, so I'm going to invest. And then they do it, a la carte, one by one by one. Whereas for a portfolio, we actually have certain rules that we have to abide by. In the first 3 years, we must find like 20 companies to invest in, because that is the term of the fund, okay? So that's number one. So why is it important? Is because you should understand who you're speaking to, first of all. Is it an angel investor? Is it a fund? If you're looking at a fund, you might want to look at the portfolio they've already invested in. Do they have companies that are a bit too similar to what you are doing? And if you are, it might sort of influence their judgment in terms of how they invest. So the reason this is important is because sometimes when you get a no from a fund, it's not necessarily because your company is not doing good or they don't believe in you. There might be other reasons. And I think a lot of fund managers do a really bad job at trying to explain this. Many of them just don't even explain. And I think it's useful for you to know that actually the reason you didn't get a check is not because of you, it's because we have considerations on our side that we cannot take this particular risk. And I think that's useful for you to know, right? So that's number one. Okay, quite clear here, right? There are two different approaches. Number two, this is something that we see very, very common. So I'm sure all of you have something like this, right? So this is hypothetical. You have an ask, okay, so 1 million, I'm just using a random number. And then you also have a slide in terms of how you're going to spend it. Now, in your mind, you look at it, you have a sense of, okay, you're building this company, these are the things that I need in terms of resources. I need to build a tech. The tech is something that's, I don't have expertise, so I'm going to have to, outsource. Then that, is going to cost me 100,000, 200,000. It's going to be quite a bit, so therefore it's going to be reflected as such. Now, the more important thing that most of the time, in my case, why we go back to startups, if we really like them, we go back to them and we ask them to clarify, is because of this. There are two other questions that many people do not answer. How long and what will you achieve? So if you say that this 1 million is for 1 year, the really important answer here is that what are you going to achieve by the end of that 1 year? So, again, hypothetical. Let's say that, okay, this is a 1 year we want to onboard 1,000 customers. Okay? Now let's just come up with a startup. Let's assume this is a startup that helps people do their will planning for their will, planning for their insurance, basically life technology, right? So your retirement planning and stuff like that. Okay, so you come to me and you say that, okay, I need 1 million ringgit. This is how I'm going to spend it, and in 1 year's time, I want to get 1,000 customers. There's a problem there. In your industry, you have to understand, is it really a technological problem to get your first 1,000 customers? I don't think so. I think it's a mindset problem. When you talk about people getting their will, signing up for wills, in Malaysian culture, it's a lot of pantang, right? So that is actually the challenge. What is stopping you from getting that 1,000, the first 1,000 people? So therefore, if you come to me and you say that you're going to spend half the amount on technology, I can immediately see there's something wrong. That spend is actually not going to help you get that 1,000 customers. So now what are you telling me? Here's the point that I'm trying to get the bridge. You are actually telling me for every dollar that I give you, you're going to burn half of that 50 cents on technology that's not going to actually solve the problem you need, and you only have another 50 cents to actually get you to that 1,000. So for me, it's a very inefficient way of using my funds. So you have increased the risk of me actually getting a return, because your understanding of how you're going to use the funds to achieve what purpose, by when, is sort of distorted. And this is a very common mistake we see. So going back to this question, like appetite, a lot of times you think that, oh, they're just not interested in us. Actually, no. Most of the time we are interested in a lot of companies. It's just that your understanding of what you are trying to solve is very disjointed from the reality of what it's going to take. So that's why it's not, now to understand this, right, it doesn't mean that you don't need to spend 50%. Maybe your technology is going to cost 500,000, right? Maybe it is. But do you need that 500,000 technology to get you the first 1,000 customers? Most probably not. Because your first proof of concept is whether people even want to use, whether you can even get them to use your product. And your technology does not answer that. Your technology makes it more efficient for them once they come on board. But they're not signing up for your technology. So this is a very big mistake that we see. And in our case, I can't speak for other funds. In our case, we actually go back and we explain this to them. And when we explain this to them, then they say, yeah, actually, I don't need 1 million ringgit. You know, maybe I only need 300,000, 400,000 to build an MVP that will get me to 1,000 users. And if I do get to 1,000 users, then I need 1 million to actually build my technology, right? Now, it's different, whereas if you're in a space where it's very technology intensive and the entire product is a technology play, then yes, you are going to have to maybe spend up to 50, 60% in technology. So it really comes down to you understanding what the space you're in. And it reflects on you because we need to trust that you understand the market that you are operating in, right? So when you see something like this, it makes us question a little bit. But then there's a leeway because in most cases, early stage, you're first-time founders, you're sort of learning. So in our case, we try to make sure that we give this feedback. So you sort of take it and build on it. Okay, so just be mindful whenever you have this slide. I'm sure many of you have this slide, but what is always missing is the follow-on slide. What are you going to achieve with it over what period of time? I think that's very important. And number three. Number three is also another common problem, and it falls into the same category of when you talk about our appetite to invest. Another reason why we might not invest is not because we don't believe in you, it's because someone else already spoiled the market. And what do I mean by that? So let's just say you come to us and you say, you want 100K for 5%, right? What's the valuation here? 2 million, okay, very good. Now let me change that. 300K for 15%, what's the valuation? Same. 550K for 27.5%, same. The valuation here is all 2 million. But sometimes what we see is someone has taken 300K for 15%, or God forbid, 550K for 27.5%. The valuation is the same. Let's say we agree with the valuation. We have no issue with that. But prior to us coming in, an angel had come in, and the angel told the founder, look, I know your valuation is 2 million. I'm going to give you 550,000. I want 27.5%. What is the problem here? What do you think the problem here is? Sorry? Yes. Yes, okay, it's related. In your first check, first of all, look, as a founder, it's very tempting. Like, wow, I'm going to get 500,000 for my idea. But what is the consequence of this? Anyone else who's going to come in the second round, they're going to look at this and going to say, the first guy already took almost 30%. There's going to be a real problem with the cap table. Do you understand what cap table is? Right? It's just the list of your investors. So even if we really like you, like someone has spoiled the market already, right? It's very hard for us to come in. And if I am very, very shrewd, I will say, okay, no worries this term, but you give me shares from you yourself. So now the founders are down to close to about 70 plus, 72.5, right? I am not happy to just, now you wouldn't want to go below 50% in your early rounds. Obviously you want control. So there's a cap already in terms of how much you can give. And bear in mind, this was your first round. You still have maybe your pre-seed, then your Series A, Series B. You know, maybe by Series B, okay, you're below 50%, but that's understandable. But in the early stage, you don't want to be giving up too much, right? So now there's a cap of how much your follow-on funds can come in. So this is related to the earlier point. How much do you really need to get to your first 1,000 customers or 10,000 customers? You got to really plan it, and then be a bit mindful in terms of the equity, because the equity is really quite precious in this sense. So again, this is not a problem with the business. It is just that it creates a lot of problems for investors when we want to come in. We look at this and like, okay, there's a problem. So, and then trying to renegotiate can be a real headache. But you didn't really need 550,000, right? Because the valuation is the same. So someone has become greedy somewhere, and then now there's a distortion in the cap table. So I just want to show you, it might be a bit small here, but I got this screenshot. There's a source down there. So this is value of founders' equity at IPO. So you look at quite a number of this. Some of them, by the time they go to IPO, the founders have 0%, right? There are some recognizable names here. Shopify, by the time they IPO, the founders only had 17% equity. Okay? So you should have an idea, and hopefully this is something that a lot of accelerators should be doing. I don't know if they put enough effort into this, but on top of teaching founders when it comes to marketing, strategy and stuff like that, I think there has to be a real understanding about cap tables and dilution. So you should, when you start up your company, you should have an idea of how many rounds of funding you anticipate to be making, and at each point, what you think the valuation will be. Of course, there's no way to know for sure. There's always going to be up to the market as well. But at least it gives you some sort of a roadmap. So you need to have an idea. If your goal is to IPO, at what point do you want to IPO? And how much equity do you want? You obviously do not want to be like Zipcar and Etsy, right? I mean, two really famous names. But apparently, I was surprised as well. Apparently, the founders had 0% equity by the time they IPO'd. So either they had to raise a lot of rounds, so they keep on getting diluted, or somewhere along the way there's been a problem that, unfortunately is too late to address. Yeah, so this is something that you want to bear in mind as well. So these three things I think is really, really important, because on top of everything else that everyone is doing in terms of, running accelerators, running incubators and stuff like that, I think it's really important to fully understand when you put together a pitch deck, the persons who are sitting on the other side of the table, actually what are they seeing? And I think there's a lot of mystery, unfortunately a lot of mystery prior to this in terms of how we see it. And I think it's really important that we try and bridge that, right? So very quickly to recap, you have to understand the type of investor you're speaking to. They have different motivations to invest. They have different barriers to investing, okay? And there are different ways that they qualify whether investment is good or not. It's not always a reflection on your startup. Secondly is, what was the second one? It was the pitch deck, right? Make sure you really understand what the problem is and what is going to get you there. Don't be spending on the wrong things, because what I see is that you're actually going to be throwing my money away on things that you don't actually need, right? And the third one is just be a bit careful when it comes to taking your first couple of checks, because it will influence your valuations going forward, but more importantly, it will influence your cap table moving forward. By the time you come to pre-seed Series A, you will realize that the first question any investor will ask you will, can I see your cap table? And this is why. They want to know like how much is left to be taken, right? Okay, so I'll just very quickly do a quick introduction of what I do. I purposely left it towards the end. So as I mentioned, I'm a fund. We're a very small fund. Bawatana, we used to invest directly ourselves, me and my partners. We set up a company, and we've been investing in companies since 2018. Then this year, we decided we wanted to set up a fund. So we partnered with Sam and Cash, some of you might know who they are, but prior to whatever they're doing now, they used to run an accelerator as well called Watchtower and Friends. And then it has not been active for some time, simply because they haven't had time to keep running the accelerator. So what we've done is we've actually come together, and we are all partners together in this fund called Jati Growth, and we look at early stage companies. We are sector agnostic. Sector agnostic means we don't pick only particular sectors. So like, for example, Tony was saying 25 startup, I think they focus more on IoT. So that means they are very disciplined in sectors. This is really a decision for the managers to make. They have different motivations. For us, we are agnostic, so we look at across any sector. So that's just a background to us. So I'm sort of manage the fund day to day. I'm the one who ultimately makes the decisions in terms of who to invest in. So that's a little bit of background behind us. And if you wanted, so this among us, among the five of us, this is prior. This is not the current fund, but the prior fund. These are the startups that we've invested in. Some together, some separately. So I'm sure you recognize some of these names here. And if you need any information, you can go to bawatana.com/jati. That's where there's particular information just on this fund. And we're happy to speak to founders. I get a lot of excitement when I speak to founders because I love learning about new ideas, and it helps me understand different sectors as well.